I don't invest in a stock just because its profits are growing, because profits often tell only half the story about what's really happening inside the company. Sometimes a company may show strong profit growth, but its core business could still be struggling. Take, for example, Eternal, formerly Zomato. In financial year 24, the company reported 351 crore in net profits compared to a loss of 971 crore in the previous year. Sounds like a big turnaround, right? But now look at these two numbers. Its operating profit was just 42 crores, while the other income, that is earnings from non-core activities, was 847 crore. This means that most of its profits came from outside the business, not from its actual business operations. And that's exactly the issue. The company may look profitable on paper, but the core business is still not generating meaningful profits. That's why looking at profits alone can be misleading. Hello and welcome to our channel 5 Minute Finance by ET Money, where we simplify investing and personal finance for you. In this video, we'll discuss 5 key things you should look for in the quarterly earnings results of a company that will help you make smarter investment decisions and avoid costly mistakes. But before we begin with the first one, please note the stocks we refer to in this video have been used for illustrative purposes only. Please don't treat them as our recommendations. So when a company reports higher revenues, it looks impressive at the first glance. But the real question is, where is that growth coming from? Let me show you why this matters. Take Hero MotoCorp as an example. Now between financial year 20 and financial year 2025, its revenues grew from 30,000 crore to 42,000 crores. That's about 6% annual growth. Not bad until you dig deeper. Despite this growth, Hero's sales volume actually fell. From 64 lakh units in financial year 20, the company could not cross that number again in the next 5 years. So where did this revenue growth come from? It came mainly from price hikes, not from selling more bikes or expanding market share. That's the difference between headline growth and real growth. So while analyzing the revenue growth figures of the company, here's what to check. Is growth coming from core operations or one-time items? Is it driven by volume growth or just price increases? Is the company growing organically or via acquisitions? Aim for companies having a sustainable growth that comes from a company's core business scaling up, not from clever accounting tricks or one-off events. Now, once you have understood revenue, the next question is how profitable is that revenue? Two companies may report similar revenue growth, but one may be sacrificing profitability to achieve it. That's why you should look at two key profitability metrics. First is gross profit margin. Now, gross profit margin shows how efficiently a company turns raw materials into finished products. It tells you how much money is left after covering just the direct costs of making the product, like raw materials and labor. A high gross margin usually means the company has strong pricing power or offers something unique that allows it to charge more than its competitors. Second is operating profit margin. It looks at how well the company manages all its day-to-day operations, not just production, but also costs like marketing, admin, rent, logistics, etc. So while gross margin tells you how efficient the core production is, operating margin shows how well the entire business is being run. But don't just look at these margins in isolation. Look at the trend. If margins are consistently shrinking, it could mean rising costs, poor efficiency, or aggressive discounting. Take Britannia, for example. In financial year 19, its operating margin dropped to 10.5% due to high inflation in raw material costs like wheat and palm oil. But by financial year 2024, they had improved the margin to 17.3% through price hikes, launch of premium products, and better cost control. This shows the company is actively managing costs and protecting profitability. So that's how you protect profitability. So always ask, is the company expanding margins or compressing them as it grows? Now listen to this carefully, as most new investors tend to miss it completely. A company can show profits on paper but still be short on actual cash. Reason: because of accrual accounting principle, which means revenue is recorded when a sale is made, not when cash is received. Similarly, expenses are recorded when incurred, not when paid. So a company might report profits even if the cash hasn't arrived yet. Sometimes the cash might even come in the next financial year, making the books look strong today but without real liquidity. Take Nykaa's parent company FSN E-Commerce Ventures as an example. Now in financial year 2024, it reported a 35% jump in operating profit to 347 crores. But if you look deeper, their operating cash flow in that year was zero. Yes, zero. And the year before that, it was negative despite reporting profits. The reason is higher receivables and inventory buildup. So while profits were booked on paper, the cash never came in. This kind of mismatch is a red flag. So always compare operating profit versus cash flow from operations. If cash flow consistently lags behind profit, it could mean the core business of the company is under stress, and over time it reflects on the stock price. So just look at Nykaa's stock since listing, it has struggled to deliver positive returns. Weak cash flows have a big role here. Next is even profitable companies can be risky. How? Let's check out. So another thing I always check is the debt level of the company and more importantly, the interest coverage ratio. This ratio tells you how many times the company can cover interest payments using its operating profits. Generally, a ratio below 2 is a warning sign. Below 1 means the company is not even earning enough to pay its interest. Forget repaying the principal. Now, for example, India Cements had a negative interest coverage ratio in financial year 23, a sign of serious financial strain. Compare that with Ultratech Cement, which had an interest coverage ratio of around 13 in financial year 23. With a low debt burden plus a high interest coverage ratio, Ultratech has a massive cushion to absorb any shocks and has enough room to grow in creating long term value for shareholders. So always ask, is the company in control of its debt or is debt controlling the company? Numbers tell you what has already happened, but if you want to know what's coming next, you have to pay attention to what management is saying. Quarterly conference call or investor presentations often reveal how confident or cautious the management is about the future. What risks or headwinds are they seeing? Demand trends, pricing power or cost pressures, and future plans like capex, product launches, or new strategies. And here's the trick, the tone of the commentary matters as much as the content. Vague answers or inconsistent explanations from management should be seen as a red flag. For example, Asian Paints reported flattish volume growth in financial year 25, but the management tone was sharp and clear. They acknowledged weak rural demand, highlighted easing raw material costs, and expressed confidence in double digit growth for financial year 25. Now, this clarity and confidence supported the stock price even though headline numbers were not exciting. That's why management guidance is critical. So, to sum up, in stock investing, no single metric tells you everything. It's the combination of all these insights that give you a complete picture of the company's health. That's it for today's video. If you found this helpful, make sure to like and subscribe to our channel and tell us in the comment what's one thing you look at in the company results.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.